everybody. Welcome to Friday, another Talk Money with Tom show. Kind of a special show today. We're actually starting a little bit late. We normally start at 12:15, Pacific time, and here we are at 1:15. It's because we were busy, making trades in our client accounts today. Wanted to get through the end of the close of the market as far as that goes. So let me describe kind of what we try to do on this show. Really, this started, the videos originally started right in the middle of the pandemic. Started the show about a year later in 2021. And so we're just trying to help people, get someplace with their retirement financially. And one of the big areas we focus on is asset management as part of that. So that'll be a big piece of what we're talking about today on the show for obvious reasons that you'll see here because of what's happening in the market. But now you can send in questions here live if you're watching this show now. You can send it in two different ways. Ask Tom at talkmoneywithtom.com, or you can just go ahead and do the chat if you're signed in on YouTube here, and Eason will see that, and we can ask those questions and try to answer those as we go as far as that goes. So feel free to do that. And then, of course, we get questions that come up from clients, from the emails that they send us, from the different strategy sessions. So we tend to try to cover those too, because usually it means somebody else has that same kind of question, and try to get through that. So completely educational. Of course, our whole channel is educational. We have thousands of videos on here now. So you can feel free to subscribe if you haven't already. And then you hit the little bell button. It'll send you notification when we put new content on if you want to try to keep up. And then obviously, if you just want to chat with Eason and I about something, on a personal basis, you can do that also. There's a link to our company website right here on the channel. You go up into the corner there's a button, looks just like that, book an appointment, and set up a 30-minute time to meet with Eason and I. We'll just kind of answer your questions as far as that goes that way. So anyway, that's what's going on at the moment for the show and kind of where we're going. I do like to start off every show with a summary of what's going on with the market, which is a pretty good thing to be looking at today. So, all right, so let me share our normal screen that we've been looking at here. And this goes back to 2018. You see that first drop that came just right over the Talk Money with Tom symbol there, and then of course the pandemic, and then we had that huge amount of money that came out. We had a huge run up, caused some inflation, dropped down. So well, look at what we're doing now. I mean, this isn't in logarithmic scale, so that drop looks more dramatic than it is because it's just based on points. The drop that's there for the pandemic was 35%. The drop that we're experiencing right now is 18.6 or 7% or something like that. So, they're not equated, but they do look similar, right? It's very fast in terms of the downturn. And really what has happened this week has everything to do with what happened in the Rose Garden on Wednesday after the market closed. And so, all along we've been talking about it in the show, kind of, what the market would like out of what was talked about on the campaign trail, what the market would not like, on, the campaign trail. So the market, in our opinion, wouldn't like tariffs, wouldn't like really mass deportations, especially out of the construction and agricultural industries, because that would raise prices in both those areas. But the market would like tax cuts, right? And deregulation of different businesses. And so unfortunately, the only things we've seen so far are those things the market doesn't like. And that's what we talked about at the end of the year, was just that there's going to be this gap between those. But this has gone a little bit beyond that, because there is never an assumption that I have seen where we would have the kind of tariffs that have been threatened, let's say at least, in the Rose Garden on Wednesday. And so the market dropped 4.8% yesterday, 6%, basically 5.97%, 6% today. So you're talking about, an 11% drop, give or take, in a 2-day period since that announcement happened. And the reason is because it was presented as reciprocal tariffs. And this seems to be the thing that's bothering people a lot. It wasn't reciprocal tariffs. So I read one article said the average tariff for U.S. goods going into Europe was 1.9% along those lines in terms of what was actually paid. But we ended up giving them a 20% tariff for the goods coming from Europe into the U.S. And then, of course, China already had 20% tariffs from this, last month, and now they up that another 34%. Now, there's still some things that need to be worked out and what have you. And of course, China responded back today with a 34% tariff on U.S. goods, which is going to hit the farmers really hard, especially the soybean farmers and what have you. So here's what people are really concerned about. It looks like, if you do the math, the way that they figured out the reciprocal tariffs revolves around the false narrative that Trump has had from the beginning, even during his first term, that trade deficits are really bad. These other countries are ripping us off because we're not, they're not buying as much stuff from us as we're buying from them, right? So if you look at the trade deficit with China, it's 67%. If you divide that by 2, you basically get the 34% that they're using. And so if you go look at all the different tariffs with these different trade deficits with all these different countries, and you divide that by 2, that's what we're giving them as a tariff.
Yeah, so you can see like major countries that are very small populations,
Right.
they're big exporters like Sri Lanka, Cambodia, Vietnam, they're getting hit with pretty major tariffs.
Yeah, and they're never going to buy as much. They're just not as big.
Yeah, they just don't have the population to buy as much.
Not possible. So Vietnam had, what, a 49% tariff. And so that was compounded by what has happened today, a couple of pieces. And so we have made a move here. We moved a majority of the assets that we had in equities and stocks and our stock ETFs and such into T-bills, short-term treasuries, and ultra short-term bond ETFs. We use all 3 of those to kind of divide things up. And what we left behind was positions that had big gains, right? Because we're not there yet where we really want to take, a $500,000 gain on something. Because the problem with the gains is that you've now guaranteed you're going to lose that money via the taxes that are going to have to be paid because you've realized that gain. It's complex because you also don't want that $500,000 gain to turn into nothing. So at some point in time, you have to decide. We're not quite there yet. Our model hasn't triggered those type of trades. We also have positions that people want us to keep. We call them legacy positions. There's lots of different reasons for that. So we still have some exposure to the stock market, but for the most part, we've moved out into these, safe areas. The reason that the compounding, we have a model, we have all these pieces, we try to stay in for as long as possible. Last summer is a great example, not last summer, summer of 2023 when the market drops 10% and then it comes back 8.9% in November. It can come back very quickly. That will probably happen here too. And the biggest problem with this particular downturn is that it's manufactured really by one guy for all intents and purposes. And that one person could change their mind and decide to go in a different direction, and all of a sudden we'd have a soaring stock market, right? However, today on True Social, Trump said, I'm not going to change my mind. This is what I want to do going forward, right? Very much so doubled down on what he's doing right now. And, very upset with China for having basically escalating the tariff war. This isn't something I think we want to sit through. I'm pretty satisfied to sit through this with the clients mostly being in, bonds, T-bills, long-term bonds we have in our bond side of our portfolio. They're doing great. I mean, they're up, a lot today. That helps offset some of the losses that are happening in the stock market. But all the stuff that was working better than T-bills like Europe and international all got hammered today. So, and we'll talk about, that in a minute, but that's the big difference as far as that goes. And then on top of that, Trump reposted a video today from TikTok on his True Social page saying that, Trump is crashing the market on purpose. He's trying to make it fall 20% this month. I don't know if that's from the high. It wasn't Trump that made this video, but he reposted it as an approval thing. And seems to be quite excited that the market is coming down, at least if you read his words. It feels like this is going to create a great wealth for the U.S. and those type of things. And who knows, maybe there's some point in time where this really does work out great, but unfortunately the change is so dramatic that the market just can't hang out.
It has to adjust to what the paradigm shift.
Yeah, the market likes that stability. We had 57 all-time highs last year. We had unemployment right in the basket where you kind of want it, in that low 4s, that Federal Reserve loves that. And then the other thing that happened today that really kind of kicked things off too was just the Chairman Powell was doing basically a speech, a question and answer period, and one of the questions was, around should we be doing something now, because of what's happening. And he said, no, I think we can be patient. We got time. And this is a Federal Reserve that's always takes too long to do things. They took too long to raise rates during that inflationary time period that came up in 2021. They took too long to lower rates. And now probably if they need to lower rates. But the problem for the Fed is that they have a dual mandate. And their mandates could be, he calls it intention, meaning they're going the opposite direction. So one mandate is to have full employment, which for them means around 4% unemployment, right? And so that's roughly where we are. I think we're at 4.2% right now. But the view of that seems to be that it's going to grow and potentially grow. And then the other one is to have inflation, in this case core PCE inflation number, down to 2%, right? That's their thing. So if you do massive, and these are massive tariffs, I mean massive, there's no way you're not going to have some form of price increase on some of these things, in my opinion. And so there's your inflationary bit, and so the Fed would be theoretically raising rates during that period of time. But see, one of the things that happens with big tariffs, for example, let's say you have counter tariffs like you have in China, whoever here working in the U.S. to produce products to sell to China, they're going to be selling less to China with that kind of tariff.
We've started to hear rumors of layoffs in factory situations that are exporters because, especially ones that are revolving about the car industry because of the tariffs with Mexico and Canada.
Yeah, so that means layoffs, in theory, less people working. Now the unemployment rate theoretically goes up, and this is what Chairman Powell was talking about. This is not something I'm making up. But so you have this dual thing happening where, they should be lowering rates to help unemployment. They should be raising rates to stop inflation. And inflation's sort of artificial, although they are playing a really dangerous game here. Theoretically, there is a window here where they could negotiate and try to come up with some better tariffs on both sides. But the damage is already started even before the tariffs. We're already seeing, we just saw the core PCE number came out last week, and, month over month it was at 0.4, right? So if you look at February of this year, which is what the PCE just reported last week, versus January of this year, you got a 0.4% increase on that core. If you multiply that times 4, that's 4.8. Okay, we're at year over year, we're at 2.8. So inflation is starting to pick up. Now, it's done that many times and then turned back around, especially on the month-by-month basis. But what's happening is the expectations for inflation are growing, right, within the surveys for consumers. And then that causes people to go out and start to buy things. Cars would be a great example, right?
Yeah, for example, my sister, because of the whole tariff thing, she went out prior weekend, and bought a car, essentially.
Must be a great time to be selling cars. I mean, yeah, because I've had many conversations with clients, even just this last week, and they're all scrambling around, kind of accelerating their car purchase decision. Well, guess what? You get, any time that starts to happen, you have a supply and demand issue. And, I guess as long as you're not selling a Tesla, you probably have some pricing power here. And, you're going to have potential to raise your costs, and because the demand is there. I mean, people are in business to try to make money. And so, that's the danger of where this is, because it's weird. I mean, high tariffs have the potential to cause both. Now, again, we had tariffs that happened in 2018, and they were just small enough and on enough weird areas that it didn't matter. But they did a lot of great studies, and they found that there was 173,000 jobs lost because of those tariffs that were put into place in 2018, which just really isn't enough to make a big difference in a big economy like this. But those tariffs were smaller than this by a factor of probably 10 or more. I mean, so then you've got the situation where they did the thing with washing machines. So washing machines were 9% higher after the tariffs, and as soon as the tariffs were expired, the washing machines dropped back down 9% in terms of so even domestic producers were raising prices because they can.
They have the pricing power too.
So it's inflationary potentially, right? It has been in the past, even looking at that 2018, looking at those studies. And again, that was $350 billion worth of tariffs on an annual basis. This is a lot bigger. You're talking 10% tariffs worldwide, 20% to Europe, 25% on some goods or most goods outside of some of the pieces that they've carved out for Canada and Mexico. You have 54% now tariffs on China. So, if you're in Australia, New Zealand, or wherever you are, you've got at least a 10% tariff to get items here into the U.S. So the market doesn't like it, right? I mean, you can tell that for a fact. So the problem that we're going to have here, especially since we're kind of out of the market for the most part, except for these other pieces that are still there, is that this can turn around tomorrow or Monday. I mean,
Yeah, he could change his mind over the weekend.
yeah, I mean, he has said he's not going to. And I'll tell you what, the thing I'm starting to realize is I think we really have to start listening to him. He's doing exactly what he said he's going to do. And that wasn't always the case. It certainly wasn't the case in the first term. It wasn't even the case early last month. I'm going to do these tariffs and then they get delayed, and do tariffs and they get delayed, And it's kind of a weird thing where you're feeling like, okay, this is a negotiating tactic. It still might be a negotiating tactic, because sometimes I think once you don't get what you want, you actually have to put the tariffs on.
It's kind of like the boy who cried wolf, and now there's an actual wolf.
Yeah, no, there's an actual wolf. And so, of course, instead of, having a negotiation with China that was going, where China comes in and says, okay, we're going to lower our tariffs if you'll lower yours, they just up theirs. So the market's not going to like that. Unfortunately for me, I think that means that other countries will look at that and possibly follow along too. Maybe Europe does some reciprocal tariffs on U.S. goods and such too. So it could have gone the other way. That's what I was talking about yesterday. If all of a sudden all these countries said, okay, and we ended up with a much better trade scenario across the board, that would have been a positive outcome from this. But Trump seems to look at this as an income source, as a way to make money. And it will be, somewhat pain-free, although he has talked about some pain, right? In a couple of the interviews that he did. But when you got him posting a TikTok video on his True Social thing saying that, hey, Trump's crashing the market on purpose, this becomes real. And now, there is one piece out here that I keep reading about in different places. I think it's kind of fascinating. We have $36 trillion in debt. $9 trillion of that debt is coming due this year, 2025. That debt, I think the average cost of that debt to the U.S. is 2.7%, because a lot of it was issued at very low periods. Right now, if you look at the 10-year Treasury, it was nearly at 5. Now it's down in the 4. Actually got a little bit below 4 today at some point in time. I'm not sure where it ended up. But one advantage of crashing the economy is that the Fed will have to, and Trump has been yelling on True Social today at Chairman Powell for playing politics and not lowering rates now. They want rates to go down so they can, deal with this debt issue and push out $9 trillion more bonds to pay off the bonds that are coming due and get closer to that 2.7% that they're paying now. It would take something pretty spectacular to do that, but they're working on it. And so there may be some reason for that, for what they're trying to do here. And again, that's probably not something you want to sit through as far as that goes, because it's a pretty dangerous game that they're playing altogether, right? I mean, because you get this type of downturn, and sometimes you just can't just turn it right around. Things can start to go. And I remember Greenspan used to have a saying, when the tide goes out, you can see who's swimming naked, right? And the concept there is that, when there's lots of pressure, economic pressure, you can see firms start to fold. We saw that in 2008. That's a great example, right? The tide went out, mortgages were falling apart, and all of a sudden Lehman Brothers go out of business, and we were already down 20-something% at that time, and we ended up dropping another 30% after Lehman very quickly too. And so that's one of the dangers that they're doing here. You got companies that have a high leverage or whatever that might be. And so again, I think, our model already triggered, but if you kind of look at what is going on, it depends on who you are as to what you should do, right? If you're young and you got a really long period of time, I mean, yesterday 4.5 trillion or billion? What was
Billion.
it? Billion
Yeah.
dollars came in from individual investors, which is some kind of a record.
I think a lot of investors from the pandemic got into the habit of
Yep.
buying the dip,
Uh-huh.
and so that mindset still exists.
Yeah, so Nvidia is way down from where it was. Could go a lot lower, obviously, but if you look ahead 3, 5, 10, 15 years, it's probably still going to be a good price today. There's nothing particularly wrong with that. The only problem that you have here, and the part that the dip buyers might not completely have absorbed, if you really study the market, you didn't want to dip buy the last depression. It dropped 87%. We're down 18 point something, right? So you do have to be a little bit careful. They call it, trying to catch a falling knife,
Yeah.
right? And so,
Are you grabbing the blade or the handle?
yeah. And so it kind of depends on who you are, how aggressive you are, how you want to do that. This could be a great buying opportunity. However, it would be awful nice to feel like Trump saw something happening, said some things, because during his first term, he did a lot of comments that I thought were positive to the market, and the market user responded well too. He hasn't had any of those.
Mm-hmm.
He seems to be wanting, and today he posts that TikTok video, he seems to be wanting the stock market to come down.
He did have positive comments. He said Vietnam came to the negotiating table.
Yeah, that's right.
And so you could see companies with exposure to Vietnam industries like Nike had a good day today.
Yeah, yeah.
And so companies may just have, depending on their exposure to each country, that's how, when tariff situation is resolved, they'll have a bump. But you don't know. It's so everyone's diversified so much.
Right. Well, and that's what I was talking about yesterday. Because yesterday I was like, look, if this is a negotiating tactic, the market could explode upward. If everybody that was out there did what Vietnam did today, and came to the table and said, we're going to get rid of our tariffs, or we're going to do whatever, to make it work. If you get rid of yours, we'll get rid of ours, and boom. So China would have done that, and Europe would have done that, and whoever else has tariffs on us would have done the same thing. The market would have been 6% up today instead of 6% down. And so that's the danger for really dealing with this type of market. This is not a structural issue like the 2008 when everything was falling apart. You couldn't just turn it around. This can become a structural issue. If they keep these tariffs up for very long, we'll have a 2008 type scenario where you really can't, again, things will break, and we won't be able to, kind of get out of that cycle without some more pain. And so, we'll see what happens as far as that goes. A couple of pieces here. I think this is from last week. So we didn't do a show last week because we had a problem with our computer setup here, which we fixed, which is great. A little hard to see this, but the very bottom, just over Easton's head, that's the S&P for the last 30 days. It was down 4.75%. And I was just trying to point out, look, there's a lot of areas still doing better, and better than T-bills, because the next one up from, Easton's head there is the kind of red one. That's a T-bill ETF, ticker symbol is BIL.
Yeah, you can it's basically a straight line. It's a very very slight slope.
Very slight slope, up 0.34% in a month. Right? So, but there's all kinds of things: the utilities, international, domestic. Large international. We have Europe. We had energy and gold all doing better than T-bills, right? And so the way our system works is, we want to be in what's doing better, right? And if everything falls apart, T-bills will be kind of up at the top, which is what happened in 2022, for example. Well, here's this week, okay? 1 week difference, same exact ticker symbols. Only one thing is outperforming now in the last 30 days, T-bills, and that's gold, right? Now, if you look at gold, it's actually coming down when, in the last, overall for the week, it's down.
Yeah.
And T-bills would have beat it on a 1 week basis. But look at the differential. I mean, you got, energy was up 4, is now down 7. Stock market's down 11, for example. So it's just all of that started Thursday, Friday. After hours on Wednesday, Rose Garden, Liberation Day, was not good for the stock market, at least so far. And we'll see how that goes long term. Here's something that we do watch also. This is a 1 month return, same thing for the green line there, right above Easton's head there, or next to him is the S&P 500. And then the red line is the Vanguard Extended Duration Treasury ETF, and the ticker symbol's EDV. What happens is that when and the bond market is actually something to watch. When the bond market starts to come up, and especially the long-term treasuries, the expectation is that we're heading for some type of calamity. So that's what the bond market's predicting. So that red line, you see how it started up pretty heavily there. And so like today, I think this was up 1.8%, give or take, for the day, even though the market was down. Same thing happened in the pandemic.
Yeah, it's where investors fly for safety, essentially. It's where they think this is the safest investment. Let's just get out of the market.
Yeah, and it's the extreme end of the safety. So the overall bond market could be up, 0.25% or something, and these could be up 2%, right? They generally will follow the overall bond market. And so it's just, but you won't see the bigger runs out of those most of the times unless there's some expectations of some real problems. And so they're going up probably with the expectation that interest rates might be coming down to support the economy. That is what happened the last time we had tariffs back in 2018. The Fed started lowering rates and they stopped doing tariffs, and the market came back in a few months, which could very easily happen again this time. It's just, again, if we listen to what Trump's saying right now, I'm not going to change my pattern. He wants this to be a revenue source. Peter Navarro is talking about gathering $6 trillion in tariffs. They'll be able to use that to offset taxes and all this. On the campaign trail, he talked about having no taxes, only tariffs, right? And so whether that works or not, the market is going to hate the transition. So, and it could be quite a period of time before, if it was going to work. And I'm not saying it would. I don't believe it would, to be honest. But I don't know everything, and I try to always remind myself that. And so, but if it was going to work, there's still going to be this kind of really tough transitionary period that we go through, because prices are going to go up very likely, very soon.
It's because you could say that everything was inflated. Now it's kind of or everyone had what their paradigm was, and now the paradigm's shifting. Yeah, exactly. All right, so that's our lengthy commentary on the stock market, and it's quite the day to deal with stuff. So we'll move on to some of the questions. Again, feel free to send in questions if you'd like. Something I didn't cover in the summary you want me to cover. Whatever that might be happy to talk to you about that. Let's go with our next question. So first question came in. We closed at the lows of today, which is really bad on a Friday. The sell-off accelerated towards the end of the day. Could we have a Black Monday-like crash next week, similar to October 1987? Well, technically no, because 87 was down 24%, and the market can't drop. It has to take these breaks. I've forgotten exact breaks. I think 7% is a 15-minute break, which really seems to help. We hit those breaks during the pandemic drop. And even during the pandemic, which was really dramatic, we ended up not having a 24% down day. So I think the market closes completely at 15% and makes us come back to the next day. Forgotten exact numbers. So the triggers are 7% in the 13% and 20%. 7, 13, and 20. Okay. So the first two is a 15-minute break, and then at 20%, it'll be a halt for the rest of the day. Halt for the rest of the day. Okay, so we can get close, huh? Get 20 instead of 24. So, yeah, actually, that's the weird thing. If you look at it, I feel like Monday is not going to be flat. Let's just put it that way. It could be extreme up. Because the weirdest thing about this, Trump could say something over the weekend that would change the pattern, of what's happening. Yeah, so some major player could come to the table, negotiating table, and that could be all needed. Yeah, so there's a lot that could happen to make the market go up. If nothing happens, then I believe the market would go down, and I wouldn't be surprised to see it at least go down, kind of what it's been going down here, which is this 4 to 6%. But yeah, Mondays can be kind of volatile because people have all this time to figure things out. They place all these trades in there. We're out today, which is okay for us. Still have exposure, still have clients with big gains and different things like that. So we're not completely out. Those are hard to deal with, but for the most part, I mean, we moved a big amount of money today. So yeah, it's within the realm of possibility that panic sets in. Because, again, the president just said, I am not going to change my pattern here, essentially, right? At all. And then he reposted a TikTok video saying that Trump was trying to crash the market.
something else has to be said, over the weekend, in my opinion, to make it so that we don't at least have this 4 to 6% type of drop. And so again, yeah, it's definitely possible in this environment. But we could be up 6 to 10% too, because we did have yesterday the $4.5 billion worth of individual money came in, kind of buying the dip, right? Probably something like that happened today. I wouldn't be surprised. And so there are people out there that buy the dip, and you get enough people that have already sold, like us, so we're not coming back in to buy the dip per se. So that is why you could get a run upward, right?
Yeah,
Based
once
on
you
something.
get all the sellers selling out, there's no one to keep pushing it down.
Yeah, the pessimism is extremely high, but and usually that's a good sign. But this is such a weird scenario and so different. Those tariffs are game changers. These aren't little tariffs. These are giant tariffs, and unless they get negotiated down or away pretty quickly, there's going to be damage that could potentially happens. And I think people are going to want to sit on the sidelines here and not watch their money fluctuate as much. Not just you and I individual, but professional money managers and big money managers and hedge fund managers who are actually shorting the stocks instead of going long. So yeah, it's a good question.
Yeah.
We have any other questions?
So what is stagflation, and why is it so scary for us?
All right, so stagflation is when you have low or no growth, and usually they're looking at the gross domestic product as part of that, and yet you still have high inflation. It's a really hard thing to do, because if you think about it, oftentimes if you have a recession, for example, people have lost their jobs, there's less money to spend, the outlook is poor, and so you normally have dropping prices in that environment, because whatever they were spending before, they either don't have or don't want to spend as much because they're worried about the future. And you get this, you almost never have a scenario where you can have increasing prices. Well, back in the 70s, which is the last time we had significant stagflation, what happened was oil went from $4 to $40 a barrel, 10x, okay? And so that's sort of an uncontrollable thing. We can't control that from here. That was actually OPEC at that time. We ended up with this energy crisis and all these things that happened. And so that, of course, oil goes through everything, even more so back then than it does now, right? And so it created this scenario where all of a sudden we had prices going up, yet the economy was falling apart, because, again, when prices go up a lot,
Demand dries
at certain points it's profitable. We saw that, I think, in 2022. The prices didn't go up so much that the demand got completely eroded. It just made for more profits for the companies. But there is a breaking point where it goes so high that it's called demand destruction, right? And it comes down, and all of a sudden, there isn't profits to be made. And we ended up with a 43% stock market drop in that time frame as far as that goes, because it's super difficult. And this was brought up by Chairman Powell in his interview and speech today, was the Federal Reserves have a really hard time dealing with stagflation because, again, you've got higher interest rates coming through, higher inflation coming through. That means you should be raising rates. But if that causes more unemployment, which it did in the 70s, then you should be lowering rates. So, what do? They have to pick one as far as that goes. So they start to lower rates, right? Then inflation could get even worse. But
the issue is they only have one lever. They really can't. It's hard to use one lever for two objectives.
Right. So that's stagflation, and it, unfortunately, this is a scenario where that could be very possible, because we have, instead of oil going up, we have these tariffs that are causing prices to go up, and around the world actually. And so then you've got potentially higher unemployment, especially if it creates demand destruction, which then creates a recessionary environment, right? And what's the Federal Reserve going to do? My guess would be, and the market actually right now, I think it's betting on 4 rate cuts this year. It was 6, it went back to 0, we're back up to 4, and so it's been all over the place. But so rate cuts would be supportive of the economy. Stock market would probably stabilize, at least maybe in that environment, but depends. bonds because inflation's there too. Earnings would be a tough one in that environment. If you get to a point where it's true demand destruction, earnings start to erode.
Yeah,
Right?
and I don't know if this administration has the appetite to do any kind of bailout bills.
Yeah,
And so that may be another fear, is that you have a struggling industry, there may not be a bailout for them.
Yeah, because that's how we got out of the pandemic, really. They just funneled money out the door, quantitative easing for the Fed and all those stimulus packages, from the Congress. Probably too much in hindsight. If you look at the stock market, it went up, like a rocket ship. But, we've got this situation. You're exactly right. I mean, would they do that again as a Republican-controlled Congress? Maybe. I mean, the House is, they get elected every 2 years. They've got some motivation to try to get things back on a even keel. You don't want to go into this election year 2 years from now as a House member sitting in a competitive district, sitting on the side of with the team that caused the recession that everybody's complaining about. It's just what happened just now. I mean, the Democrats were in charge enough there where they got, they got the yoke of inflation put around their neck and lost the election, lost the Senate and the White House and what have you. So, yeah, they may be able to do something. There may be some will there. Now, what it'll be interesting because there's a lot of dynamics here. What does Trump want? How much sway does he have, at any point in time? Does his sway ever lessen because we're having so much trouble economically? It's very, very dynamic. Usually, honestly, when you look at the Congress and the White House, we're not talking about them as much when we're talking about the stock market, but we have to. In 2020, I mean, they were the reason the market came back. You look at it now, this is probably the reason the market's coming down, right? I mean, heck, we had 57 all-time highs last year, and we had a 26% year in 2023, a 24% year on the S&P 500 in 2024. Those are great numbers, and so now we're down 18 point whatever. So this is they're trying to restructure the American system. It would be painful. Maybe they'll be right in the end. That's our hope for this, but I think that transitionary period could cause some stagflation. Right? So, all right.
So, because of the new extreme policies, do you think the Fed would ever completely end QT and restart quantitative easing this year to save the U.S. stock market?
Yeah. Well, no, that'll be part of the package. They've already stopped quantitative tightening, right? And the bond market has responded there at least somewhat positively to that, on top of the other things that are happening. And so yeah, it's quantitative easing, and then it's stopping and quantitative tightening. Those are the three, kind of a green, yellow, red light scenario. Yeah. We're in that yellow light scenario already, where they have stopped doing the quantitative tightening, where they're trying to dump bonds off. I think they were at $9 trillion worth of bonds on their balance sheet. That's down back to 6-ish, I think, as I recall from the last article I read. And so, yes, they could start to buy bonds. The problem with quantitative easing, if you read a lot of the articles that are out there, it's still controversial as to what it is and how it really works. Does it actually cause a stimulus to the economy? But yeah, I feel very strongly, the Fed does, when they get rolling, like they did in 2020, they'll lower rates quite rapidly if they need to. Maybe they'll be late. Probably they'll be late, both on the quantitative easing. But yeah, I could see quantitative easing picking back up again as part of their package. So I guess that's the other tool they have. We were just talking, They have one tool. But the quantitative easing is new. That started in 2008. That's the first time they tried this, in that downturn. And so that, is still to be seen whether that actually works as well as the raising of interest rates or lowering of interest rates. But yes, I could see that happening for certain. And again, we're holding on to all of our bonds. We moved the equity portion, massive majority of it today into T-bill type accounts. So it's not going to gain or lose much anyway. But on our bond side of our portfolio, we have regular bond market, Vanguard Total Bond Market Index, those type of things, but we also have these long-term bonds that are doing really well today. So we're still bullish on the bond market. Matter of fact, you see our signals, we're green on the bond market. We're red on, the stock market, but the bond market is, and so again, this was supposedly part of the strategy. that has been presented in a couple of these articles. I don't know that this is true, right? This is just what's been presented. It's kind of playing out, but $9 trillion worth of debt that has to be refinanced this year. That debt is currently at about 2.7% cost to the government. So if you crash everything and everybody runs into bonds, when the value of bonds go up, the yields go down. So 10-year Treasury was at around 5, now it's at around 4. Yeah. And so,
4.
hey, does that get back to 2.5 or something along those lines? And that quantitative easing would be part of that, right? Because they're buying bonds on the market. So it's not just you and I buying bonds, it's the Fed buying trillions of dollars of bonds. And all of a sudden that drives the price up because it's supply and demand, and that drives the yields down. They can refinance their debt and then, go off. And so this could all be one big strategy to try to refinance debt. Who knows? It's very difficult to tell. I mean, they're not saying what they're trying to do. What are they going to do with this $6 trillion? Where is it going to go? Right? That would be nice to know as part of the plan, because I think the market might, maybe see something that it likes in that. To not say anything is tough. So, yeah, that's a good question. It's I think that definitely quantitative easing is in our future. If these tariffs continue to stay in place for a long enough period, the Fed will have to react.
Is gold a good defensive investment?
Oh, we have a chart on that one. Let's see here. Okay, so this is the S&P. This is a little bit old, actually, but
It's a week old.
It's a week old. We had this ready for the show last week that the computer didn't turn on for us, but this is the last 12 months, and you see the S&P at least as of last week was up 6.2% in the last 12 months, and so gold was up 37, really 38% if you round that off. So, yeah. Gold's going up in this particular environment. If you look at that pattern, it started before this downturn.
Yeah, it was going up in an up market too.
Yeah.
It wasn't actually being used as a defensive investment.
Yeah, because if you look at what we talked about today, let me get back to that. Let's see here. There. So gold is the only one that's left after 1 week here on a 30-day basis that still has a positive rate of return. But it's been falling all week also, right? And T-bills, if we looked at it just from a short period of time, would have outperformed gold. And so here's my outlook. I've done a lot of back testing on gold, and we don't use gold because of that back testing. It has two issues for me, and I don't have any problems with anybody that wants to do it, but just as a professional who has to stand in front of a client and maybe stand in front of a jury or whatever it might be, gold is too volatile for what we want to deal with, right, in terms of the volatility of how it moves. But also, I have a very strong memory of what happened in 2008 when there was no diversification. There was no safe haven. Everything fell. And that's because when companies really get in trouble or countries get in trouble, whatever it is, they sell everything, and gold or whatever it might be. You got to sell it because you got to pay the bills or you got to deal with it or liquidate it. And so that's the issue. And then long term, you could have your money in the S&P 500. So here's 5 years. So 5 years, the S&P 500, again, this is a week old, I'm sorry about that, is up 124%, and gold's up 85 or 86. Not bad, right? But you're actually detracting from the overall stock market rate of return over that 5-year period.
Yeah.
With gold in the portfolio.
There's periods where gold will outperform the market, and there's no problem in having it.
Right.
It's just, where's the long term? Is it a long term hold or?
Yeah, it's more something that you probably should play if you could figure it out and maybe study it more than I do. Because obviously you can see it's done well here in the last year versus the market. But if you're just going to hold on to it, and historically, if you look back, you were just to try, because when you back test something, you say, well, I could own all the S&P 500, or I could put 5 or 10% in gold. You would have been better off with all the S&P 500, obviously, in the last 5 years. And so, that's part of the problem for us. It has to be something that's adding to the returns. I mean, we're already charging a fee. We're trying to make up the fee and then some. So we're already behind the, 8 ball as far as trying to beat the market anyway, or even keep up with the market. So can't have things that are going to really go back. And so I would rather play the long-term Treasury side, which is less volatility, has about the same volatility as the S&P 500. Standard deviation around 15, 16 usually, which is less than gold. And so I'd rather, if I'm going to play that, which is what we're doing right now, I'd rather play the long-term Treasury market for those periods of time because I see that as a good hedge, right? Because that's where people tend to run to. Treasuries in general, I just use the long-term for those higher end hedge because it will move more, right? T-bill, as we saw, doesn't move at all. That's a Treasury, right? Yeah. But the longer term, you get out there in that 20-plus year term, those will move a lot. But they'll move as much as stocks. So you have to be careful. It's not something you should really, take your eyes off of. But it doesn't move that much more than the S&P 500. So that, to me, that's a better hedge than gold. And that's what we've been using. We used that in 2020 to great success. We actually made some really good money on a couple of our trades in the long-term bonds in 2020 because, again, people were running to that. There was a lot of, of issues out there. So, okay, well, we're done with our delayed show today. I want to thank everybody so much for coming. Thank you for the questions. I love to get those, and hang in there. We'll get through all of this. You think back to 2000, 1973, 2008, 2020 downturn. I mean, we're higher than almost all of those now, even with this drop. And so this is kind of how the market works. The numbers we're seeing now haven't happened for 5 years, so that's not unusual either. You kind of get this 5 years of okay markets. Now, we're getting the bad part is happening now, but we'll figure it out and keep walking through this thing. And unfortunately, this is a really different scenario, which has been part of the hallmark of recent times, right? The pandemic was different, right? And so
and the market's much more reactive and rapid.
Yeah, it is. I think so. There's a lot of computerized trading models out there that might make it more so. So yeah, it's we'll see how it plays out. That means it can come back quickly, which is what we saw in the pandemic. So. Okay, good. Then I will look forward to seeing you again next time. Send in your questions during the week if you want. Ask Tom and Talk Money with Tom, and we'll be able to get ready for those and answer those next week. And then of course you can subscribe to our channel, hit the bell, to get notified when new things come out. And then, because I do these videos every day on what's happening in the market, so you can get those. And if you'd like to see, what our thoughts are at any point in time. And then lastly, of course, is just, if you feel like you want to just talk to us, go to our website, hit that book appointment button and schedule something, and we'll talk to you. All right. Well, thank you very much, everybody. Sorry for the delay today, but we had to take care of the clients first, and look forward to seeing you next week. Thank you.